Hey everybody, Alden here from Better Wealth. Welcome back to the channel. Today, we are going to be diving into 3 policies that were sent to my team that ultimately I ended up reviewing and meeting with these 3 clients for a review of their policy. Hey, is this doing what I want it to do? Was this designed the way that it should have been based on my goals? This is where I love. This is the kind of thing that gets me up in the morning. I got into this industry, as some of you may remember, through some really shoddy sales tactics, half-truths, and outright lies around an insurance policy that I purchased. That policy, back when I purchased it, I thought it was the coolest thing ever. And then every couple of months, I better understood what I had purchased. Every couple of months, I started to peel back those layers and realize, oh, okay, this is not what I thought it was. This is way off base. And there's a lot of not true things that were told to me to make that sale happen. I got so pissed off that I became a life insurance agent to fix that policy, did a 1035, left it, and started in the career industry at that time because I loved it so much. So today, we're going to be reviewing those 3 policies that I mentioned. And the first one I want to show you is coming from a lady. I'm not going to tell you her name, but she's a single mom, makes a good income, has 1 daughter, and her situation is kind of interesting. She approached an agent from a very large mutual company, which we'll dive into here in a second. And she just had a conversation of like, hey, this is something I want to do. I want some death benefit protection for my daughter. And I also want to do some long-term savings in a really good structured vehicle. So she already understood the value of the death benefit and the value of having cash value. So she's looking at a Northwestern Mutual policy. Now, Northwestern Mutual, fantastic company. They're actually the second largest mutual insurance company in the United States. They were founded way back in 1857. So they've been around almost 200 years. In about 25 years, they'll be around for 200 years. And then they have been paying dividends basically since 1872. So they did start as a stock company, nothing against them. They fixed that problem about 152 years ago. Northwestern Mutual, apart from being a massive company, they have a very high financial stability rating. So in the insurance space, as you guys may recall from other videos, they have what's called a Comdex score. Comdex is a conglomerate score of multiple different rating agencies. Northwestern Mutual comes in at a 100 out of 100. They're the big dog in the arena. They have a very, very strong score, and they've also been around for a very, very long time. Now, one of the things that we're going to see as we start diving into this policy illustration is the biggest dog in the fight doesn't necessarily need to be the most competitive because they have the largest market share. So in this context, the individual that she was working with, the agent that she was working with at Northwestern Mutual, was given directive by her basically saying, hey, I want a policy that grows cash value and does it very efficiently. So what we're going to see on our screen here is a first pass that this agent took. So this is a cash value efficient policy. See my quotations in my fingers. And all this really is, it is a premiums payable to age 100. So this is their plain vanilla whole life insurance to age 100 policy. We can see in the Northwestern Mutual illustration, they're putting in $12,000 per year into the policy. Now, we can tell right away because the accumulated value, so that is the net cash value, it's a big goose egg in year 1, that this is not a cash value focused policy in the way that we would design it. It is whole life insurance, and a permanent insurance product, most of them, especially whole life insurance, is going to give you the byproduct of cash value. That's just what happens in those types of policies. So it does grow cash value fairly well over time. I'd imagine this comes out between a 3.5% and 4% internal rate of return, but the large degree of this cash value shows up way down the road. I saw in the photo she sent me, there was a highlighted mark here for, I'm not sure what reason per se, the break-even point in this policy, as I know a lot of our clients care about that, is year 13. She saw this, she thought, I don't think this is what I'm looking for. She saw some of our videos, went back to her agent and started effectively telling her what she was seeing online, what might be possible if it was built another way. And changing screens, this is now the second pass this agent took, building a cash value focused policy. Same product, premium payable age 100, whole life insurance. And if we come down here, net cash value, I'm not sure why it increased by $114, but basically the same $12,000 per year, net cash flow. All the way over to the right, we see the accumulated value. This does include the dividend payment. And so when we're looking at this right away, we can see if we do some quick math, we can see that we put in 12,000. We ended up at the end of the first year with $7,362. So doing some simple math, dividing one into the other, we get around 60% of our premium in cash value. Now, you and I know that if we go build that at another carrier, build it differently, perhaps even with Northwestern, that we could change that narrative. We could get a lot more cash value in here. So in our conversations, one of the first things she wanted to figure out was, hey, is this policy structured well? And my answer was, this is a fantastic company. This policy does generate a lot of cash value. But is it the best that we could do? No, it's not. The downside with Northwestern Mutual is that they are a captive insurance company, which means if you as an agent work with them, they don't allow you to work with anybody else or they cut your contract. So the problem I have with this is that Northwestern Mutual agents, love them or hate them, I actually know some of them and I really do appreciate and value their service, but they don't have the ability to give you many options. We at Better Wealth really believe in the value of options. It's one of the reasons we make it a point to be able to write with almost a dozen insurance carriers. And about 7 of those we write with fairly often on the mutual insurance side for whole life insurance. So what I'm going to show you now is the what if. What if we built this policy differently with a different company? The second company we're looking at is Penn Mutual. So Penn Mutual as a whole has been around since 1847. They've been paying dividends every single year since they were founded for 177 years. And they have a very strong financial portfolio, very strong financial products. And it's one of our favorite companies to work with because of the flexibility and long-term performance. So the numbers that we're seeing here on your screen, premium outlay, completely the same, $12,141. Cash value in the first year, $9,600. So, okay. So initially, at the very first pass, let's go back and look at that. Very first pass, 0 cash value. Second pass from Northwestern Mutual, we've got a better cash value, about $7,300 at the end of the first year. By doing this with a different insurance company, using the same assumptions, building it the way we build it with really maximizing that cash value growth, we now get basically an extra $2,500 in cash value in that first year. So what's the trade-off? Well, oftentimes when we are building a policy to focus heavily on cash value, we sacrifice death benefit. But the interesting thing about Northwestern Mutual and the way their policies are structured, they don't actually give you a whole lot of death benefit for the amount of premium you're paying. And so this could be a design thing. I don't work with Northwestern. If somebody knows why this might be the case, educate me in the comments below. I'd appreciate it. But what we're looking at here is the same premium. More of it is going toward base premium. We can tell because we have less cash value in this policy. And over here at a different carrier, we have more cash value, same premium, and almost double the death benefit. That's just interesting to me. What I've seen a lot of in the industry is if you're the biggest dog in the fight, whether you're in the property and casualty world for home and auto, or the biggest dog in the fight for life insurance, like Northwestern Mutual or New York Life, they don't have to be as competitive because they have a huge market share already. That may harbor some truth in this example as to why we're seeing what we're seeing here, but I'll let you make that judgment. So if we look at this policy, the cash value component is very, very strong. Higher early cash value. It gets to a point where it breaks even. You're just shy of breaking even year 5. This is at a preferred assumption. If she gets preferred plus, then there's a very good chance it would break even in year 5, but definitely breaks even in year 6. So what I'd like to do is I'm just going to throw out a couple of numbers so you can see the difference. Okay. After 10 years, 142,000 cash value, and then 708 in the death benefit. So we go back over to the cash value focused policy. Let's go after 10 years, you got 132 instead of 142. So that's about $10,000 difference, comes out to just shy of a 7% difference in cash value over 10 years, which is fairly significant if you start to look at that long term. And the other thing I wanted to look at is after 10 years, what's the death benefit? We have a 468 on this policy with Northwestern. So we're looking at a fairly large difference in death benefit after a decade. We've got over $230,000 of death benefit more in this policy. And from a percentage perspective, we're looking at close to 40% difference. So over a decade, a lot can change, right? We are assuming dividends. We're assuming company itself is going to be paying a certain guaranteed interest rate. That is actually a guarantee, not an assumption. Dividends assumed, the premium that you're paying is assumed. It's assumed it's being paid on time every year on the anniversary date, before or after, everything changes. And so to play devil's advocate here, the product itself has a lot of assumptions in it already. But the nice thing is whole life insurance, in the way that it's structured, is guaranteed to increase in value every single year you're alive. The only question is how fast and how much flexibility you have along the way. The policy we're looking at here has a lot of flexibility. Minimum premiums around $2,000, maximum premiums around $12,000. So in this context, this would be a better option, in my opinion, than the policy we just looked at. To kind of hammer home that story, I'm going to go down and look to year 60. So these policies are identical to year 60. Both include a waiver of premium. You see the premium drop off here because the waiver of premium drops off after 60 years with this carrier. Northwestern, I believe it stays on for until age 65. So if we compared this last year, total cash value is 546. Death benefit is 1.24 million. Jumping over into Northwestern, going to age 60, so 505 instead of 546. So that 7% difference in cash value has held true for the entire policy. We're looking at around almost 8% difference in cash value over that time frame. And The death benefit as well, age 60, we have 925. Okay, so it's a 26% difference in the death benefit. So this is a much better designed policy. Now, the unique case that I'm working on with this particular client is this policy may not even be a good fit anyway. So what I'm showing you here is, hey, this is the best way to do it if you want this policy and if this is the right call. Based on our first conversation, likely we're going to be looking at something completely different. And that's okay. But my point in doing this, guys, is to show you that not every carrier, not every product, and not every agent is created equal. I want to believe that every insurance company is out there to provide value, and I think they absolutely are to a large degree. Not every agent has the ability to provide the same level of value due to knowledge, oftentimes due to other motives per se. It just depends. And so where we find ourselves in this video in particular is a change over time that brings more value, more access, and more flexibility by doing it slightly differently. Same contribution, doing it differently with a different company. All right, so that's the first one. All right, so guys, this next policy that we're going to dive into is from another fantastic mutual insurance company. It's from Guardian Life Insurance. Guardian, a couple of quick facts about them. They have been around since 1860, so pretty close to Northwestern Mutual. They were in 1857, I believe. They've been paying dividends since 1946. So the interesting thing about Guardian, I did a review on Guardian. We love them as a company. We use them quite a lot. However, in that video, I indicated that they've been paying dividends since 1924, which apparently isn't quite true. Thank you for the person who pointed that out. 1924, there was effectively a news article that indicated that they were planning to go mutual. They didn't actually until 1946. And so because of that, what I said was inaccurate. What appears to be accurate is they've been paying dividends for about 78 years since 1946 when they became a mutual insurance company. Guardian, again, fantastic carrier. And they have a Comdex rating of 99 out of 100. So very strong financial carrier as well. They're one of the big four, if you're familiar with that term, largest four mutual insurance companies in the United States. So what we're going to look at today is a policy that was sent to me through somebody filling out our form online, sending over a policy for me to take a look at and review. This is an existing insurance policy. It's been in force for quite some time. And the needs of the owner have changed. And so one of the things they wanted to assess and really find out by working with us is, does this policy still make sense? Now, I'll be the first to say that if in-force life insurance, if it's older than the decade, in most cases, it's better to keep it than to start over. But we also have to consider flexibility. We have to consider death benefit needs, cash value focus, like all these different things. There are different riders on the policies. All those go into, should the policy be changed at the carrier, changed by doing a 1035, or what the solution will be. So this particular policy is fairly young. It was issued at the December of 2020, so only a couple years old. And we've got a planned premium per year of $25,250. Now, the interesting thing about this particular person, he and his spouse actually got identical policies. Hers is built basically the same way. And they were purchased as a cash balance plan through the pension provided through their business. Now, ultimately, that business got sold and they separated from the company. And what they ended up having to do is, I won't go into the details, but effectively, because those weren't their dollars, those were tax deferred, kind of like an executive bonus plan, tax deferred dollars put into the plan for them. When they separated from the company, in order to keep the insurance policy, they effectively had to pay a lot of money. So now they own the insurance policy outright, but they weren't able to change the structure. A lot of executive bonus plans, they are primarily whole life insurance and primarily all or over 50% base funded policies. So when we start to look at this policy, we can see right away that they've been funding this for 4 years now, and they've put in $25,000 every year for 4 years. They've got around almost $100,000 of cash value. So even though it's an all-base policy, guys, cash value in life insurance is a thing. It happens. So it's a very good byproduct of buying a death benefit through a whole life insurance product. So when we look at the actual illustration, we can see this is their whole life 95 product. The product actually is still being sold at Guardian as well. Great product. Issue age was 39, preferred non-tobacco. And the policy premiums, if you look right up here at the top, premium of $24,000 and some change is buying whole life. So there's no term. There's very, very little paid up additions, about $250 of paid up additions, which I think is kind of comical that we just threw that in there for fun. And then we also have the paid up additions waiver as well as a waiver of premium. So Guardian is a pretty cool company in that you can purchase a waiver of premium that covers your paid up additions. However, it only covers scheduled paid up additions, which in layman's terms, a scheduled paid up additions means that it's built into the policy premium and you can't skip it. If you skip it, there might be a problem. So not truly a flexible PUA like a lot of the companies that we work with. Guardian also has unscheduled, which makes this work. Now, the cool thing here is that this particular policy has an index participation feature. So over the last 5 years that since this policy has been in force, it has been participating in stock market indexing. Now, the cool thing is it's actually driven a fairly close value marker compared to what was illustrated, and because of the index performance. So this is 100% of the dividend is being allocated or attached to index performance. They can go upwards of about, I think it's 10.5%. On the low side, they can't lose below 4%, but then there's a 2% fee that comes in. So really your floor is 2%. So for some clients, it can be kind of a cool thing. So we look at the policy design itself. I think this is great. I think it's a really strong cash value. Now, the gentleman that came to me and started talking to me about this policy, his needs have changed. The company's got sold. Now he's funding his policy out of his pocket. And in his mind, whole life insurance can be a fantastic place to store money. And what he wants to do is pull money off of investments every year. When the stock market has a great year, he's going to pull from his portfolio and shove money into life insurance, pay the tax on that gain, put it into a vehicle where it'll never be taxed again. I think it's a pretty cool system. So what he and I did going through this policy is I said, look, I think it's a great policy. I think the only way we're going to figure out if this is a good thing for you to keep or not is let's get an in-force illustration showing that you're putting in the maximum PUA into this policy every single year without mecking it. Now, Guardian has some pretty interesting rules around their paid up additions. What I mean by that is the first 10 years of the contract, you have the ability to do basically 3 times your base premium in paid up additions. After year 10, that drops. And so the amount that you can do after year 10 is 2 times the base premium. So if your base premium's basically $24,000 and some change, they can double that, put in a total of just under $50,000 starting in year 11. The particular policy that we're looking at right now, we'd asked for an in-force illustration. And very specifically, we wanted to make sure that this policy did not mech. So we wanted to put in as much money as possible without mecking the contract. And so they couldn't technically go all the way up to the allowable PUA premium, because if they did, it would mech it. So we have this bit of a yo-yo going on. Every year they put in a different amount, and we're just assuming they're going to do whatever the mech test says they can do for that year all the way forward. And if we run this out, you can see these numbers bounce back and forth over a long period of time, then finally level out of about $24,218. After looking at this is a fantastic place to store capital. I don't necessarily think this is a bad policy at all, but he's very healthy. He likes flexibility, and we wanted to look at what are the options. So what we did is I built with Penn Mutual again, I built a new policy illustration showing a 1035. I'll walk through those numbers in a second. What we were able to do is a little bit of a precursor is decrease his minimal required premium, increase his efficiency by a large percentage as well as large cash value, give him longer death benefit, as well as add an enhanced disability waiver premium. Looking at a comparison, this again is with Penn Mutual, we are doing a 1035. So what the idea here is, guys, is we're taking the net surrender value of the other contract, which is around $96,000, rolling that into a new life insurance contract, and then planning to pay additional premiums. What I did here is this is showing policy year 5. So they are going to be paying in the current in-force illustration, $72,405 out of pocket this year for a policy anniversary. What I'm showing is they're going to be paying that $72,405 out of pocket, plus we're going to roll over the cash value. So the first thing, so premium outlay out of his pocket is the exact same as what I'm saying. The first year, what I want to show and highlight is Penn Mutual does an end of year age. Guardian does a beginning of year age. It's the same year. That can confuse people, so I'm saying that now. The death benefit on the Guardian policy is about 1.8. Cash value is about 168. Death benefit is about 2.2. So Penn Mutual does have a higher death benefit after the policy would be enforced. Cash value does go down. Alden, why does the cash value go down? So glad you asked. The answer is because anytime we do a 1035, whether it's into a UL product or a whole life product, there is a cost of transferring a policy. Okay, 80% of the time, 100% of the time in the cases that we build. That cost comes in the form of a load fee. So where we're putting those dollars in a 1035, it's coming into paid up additions, driving up the cash value, driving up the death benefit. Every carrier charges a load fee to some extent on paid up additions. And so their cash value that's being transferred as well as the premium that's being paid get hit with that fee. Penn Mutual, their first year load fee is 10%, then it drops to 5% long term. That's basically the industry average. And so if we were looking at what's going to give me the most cash value this year, this is not your solution. Most of the time when I'm going to be talking to clients, I want to figure out their goals. What are you focusing on? For this gentleman, it was flexibility and long-term performance. And so coming back into this policy, let's look at that second thing, long-term performance. Premium outlay is identical to what was being illustrated at Guardian. I had to manually type all these numbers. It was a load of fun. And so what we see is after 10 years, we've got a total cash value of 962,000, death benefit about 3.5. Over here, after 10 years, cash value is 941 and 3.5. So death benefit's basically the same, but Penn Mutual at this point, after about a decade, has gotten ahead from a performance perspective. Now, what else is beneficial about this policy? The Guardian policy that we're looking at right now, minimum premium is $25,000. Their ability to put in up to the ceiling, which in this case is just under 28 grand, is curtailed based upon the MEC limit, because this policy is only whole life insurance. There's no term insurance. We don't have a way to get more death benefit on there to prevent a MEC. So we have this yo-yo where if you wanted to max fund it, he can't quite do it when he wants to. He has to play within those rules. Penn Mutual, in the way that they allow us to build their policies, I've put term insurance on here. And that term insurance makes the policy cheaper from a minimum premium perspective while getting us a higher death benefit. The benefit of doing this is now we've got a smaller minimum premium. This policy has a minimum of about $16,000 instead of $25,000. So save him about $9,000 right there. And then additionally, your funding ability for paid up additions goes all the way up to that 97,655 number. That's the maximum premium. And you can do that whenever you want. We could do that every year for a period of time. Now, long term, we couldn't do that every single year for the next 30 years. We'd have to slow it down eventually. But year to year, we can exercise that upside potential and ability, which is pretty cool. So going down, I'm going to go out to the last year that I illustrated, but total cash value 3.8, death benefit of 6 million. Going out to age 70, we are $700,000 shy at Guardian for the current policy design, the way it's being funded, identical dollars in, and about $400,000 shy on the death benefit side. You tell me, if I could get somebody a policy, if they can requalify for insurance, restructure it, give them more flexibility, less required premium, a higher cash value long-term, and a higher death benefit long-term, and for kicks and giggles, adding in an enhanced waiver of premium that has a true own occupation definition, so that if he gets disabled in his current line of work and then files a claim, then goes and does something else and earns more money, the policy is still waived. Is that a good thing? I would say yes. So this particular client, we're going to be moving forward with this policy. We actually just met today. So if you're watching this, hi. I think this policy is going to be a very, very good thing because it's going to give him everything that he was looking for, increased flexibility, all the benefits that I just mentioned. And the only kicker is, can he qualify for insurance, which we'll find out. But I have a very strong assumption that he will because he's ridiculously healthy. So I think we're going to be in a good spot. All right, so now we're going to dive into the last illustration I'm going to review for you guys today. Again, these are all great companies. This is, again, with Guardian, fantastic whole life company. And this particular gentleman was in a unique situation. He had been going through a process of basically trying to educate his agent, similar to the first lady we worked with, educate his agent to be able to build a policy like we talk about on our channel. So he's actually already gone through underwriting. He's already got an offer from Guardian Insurance. And we're at the point now where we're looking at a whole life 99 product. So this is a good product for cash value growth, not the best product that they have, but it's still a very good product. And looking down into it, this is the I think he said third or fourth iteration of this policy design. He kept wanting cash value focus. He kept wanting flexibility and premium. And oh, by the way, let's throw on some long-term care benefits. And so this is what he was ultimately presented. And I find it quite interesting. So 44-year-old male, did get a preferred plus non-tobacco offer, which is fantastic. Has not signed on the dotted line or paid the premium. And where we are now is we're looking at a net premium of basically $22,500, give or take a couple of dollars there. What this policy is basically 100% whole life insurance. There's no term insurance. All that death benefit is coming from two places, one being whole life insurance premium, two being paid up additions. Paid up additions is either coming from your pocket or coming from the dividend that comes in and buys paid up additions. If we look up here, the other places dollars are going is long-term care insurance. We have a massive pool of $950,000 of long-term care accelerated benefit rider, which effectively just means, guys, you can accelerate, so take from the death benefit before you pass all of that money over a set period of time with a set dollar amount per month, which is pretty cool. We've got, again, that fund. Let's just throw it in there for fun. Paid up additions rider, $250,000 or $250, excuse me. And then we have a waiver of premium for both the PUA, again, kind of funny, and then the true premium. So when we look at the policy values, we can just go ahead and see that even after 10 years, we haven't broken even. I think the technical break-even point, golly gee. All right, so we're 13 years into the future here. We still haven't broken even. 16 years into the future, We have now broken even on this policy. So from a cash value accumulation perspective, this isn't cutting it. And unfortunately, the agent on the other side didn't know how to do that. Now, the cool thing is, guys, Guardian can do this. We can do a cash value policy with Guardian. The more I talked to this individual, I better understood his goals and what he values. One of the things he values is flexibility, long-term ability to fund into paid up additions. In other videos when I've reviewed Guardian before, guys, is we have very, very good policies that Guardian can give us if we're doing short number of years that we're funding or a high front load preceded by a short number of years funding. When we try to fund long-term, the way Guardian's paid up additions riders works is they start to limit your ability to put money into them. This is similar to what I commented on the last review. After year 11, they limit the amount of paid up additions you can put in based on the size of your base premium. So what I did is we had that conversation and we jumped into looking at different policy design. So different policy, going back to Penn Mutual, and we're looking at this policy. It's basically the same outlay. I did round up because I was being a little bit lazy, didn't want to do the math for an extra $11 to be taken off. And we get to a break even basically in 6 years, almost there, but it does break even in year 7. Now, depending upon the health rating he receives, this could break even in year 6, which is pretty cool. The death benefit is going to be the biggest difference in this policy day one, apart from the cash value, which is obvious right there highlighted. Death benefit on the other policy was $1 million. We basically cut that in half. What are we getting for cutting that death benefit in half and paying the same premium? We're buying less insurance, which means we can buy more paid up additions, which is going to drive cash value performance. Now, a lot of the naysayers in my industry say, like, you are not valuing the death benefit. You have to make sure people are protected. I 100% agree. 100% agree. But if I can use term insurance to protect the time between the drop off in death benefit in year 1 to when the policy gets back to $1 million of coverage, I think that's reasonable. So looking at 15 years of insurance coverage, I think would be very reasonable, because after 15 years, we get to a point where we're about $1.2 million of insurance coverage. And along the way, we get more flexibility, more cash value. Look back at the Guardian policy. After 13 years, we're about 1.1. So even though this policy is buying only whole life insurance, a truly max funded policy, a true paid up additions focused policy, cash value focused policy, is going to have a better death benefit long term. Because what paid up additions is doing is buying more death benefit. And the byproduct of buying more death benefit is cash value. So if we look at this policy, just from an efficiency perspective, after 10 years, it's basically no context because we're adding in a lot more paid up additions and more flexibility. $288,000 after 10 years. Over here, we are $122,000 behind. Yikes. We are almost back at $1 million of coverage. Other policy, we are just over $1 million of coverage. So in a decade, we kind of end up in the same place from a death benefit perspective, more flexibility along the way, minimum premiums a whole heck of a lot lower, more options on the paid up addition side, and we have the ability to fund this policy long term. Now, the interesting thing is, through our conversations, this policy is not what we ended up going with. We're going with a different one. Different funding structure, a larger premium, even more flexibility on the high side. The big thing that this particular client was concerned with is he wanted to have the ability, but not the requirement, to put in money. So we lowered that requirement. The minimum premium on this policy is about 6. On this other policy that we're going forward with is around 13. But it gives them the ability on the high side to put 50 grand into that policy every year, which is fantastic. And the nice thing is that with this carrier, they don't take away that ability to put in money long term, because Penn Mutual doesn't take away your ability to fund into that paid up additions rider long term. They allow you to continue to fund into that rider as long as you're paying at least half of what's required in 1 year over a 5-year period. So let's say, for example, your policy allows you to put in an extra 10 grand into paid up additions. That means in a 5-year period, you have to come up with at least $5,000. So $1,000 per year is what I'm saying. So very easy to keep that flexibility alive. Guardian has the constraint on the amount that you're allowed to do, and it decreases over time. First year, you have a very high limit. Second year drops it to a 3x multiple. Year 11 drops it to a 1-to-1 ratio. And so the new policy, the new design gives him a little bit more peace of mind, closer to his goals, a larger degree of flexibility, and more permanent protection for his family long term, which is really, really cool. The last thing I'll talk about, the elephant in the room here, guys, is this long-term care rider on this policy. So we have to understand this is not long-term care insurance. What it is the ability to accelerate the death benefit, so spend it before you pass, of up to that amount over a set period of time. So if we're looking at that section, basically take out $19,000 maximum. If he did the maximum, it would last for 50 months. So 19,000 times 12, it's about $230,000 per year, give or take, and lasts for a couple of years. Amazing. So what are we going to do with that? Well, Penn Mutual does not offer long-term care rider. I think long-term care riders are really slick, But at the same time, what's the true difference between a long-term care insurance rider and an accelerated benefit rider? We know that a long-term care rider just accelerates the death benefit anyway. So what's the difference? The difference is how the IRS classifies it. All right. So this is a document that's actually very helpful for comparing these two. The cool thing here, guys, is that an accelerated benefit rider actually covers a lot. So one of the things that it does not cover necessarily is a coordination of care, right? So think of it this way. If you have a long-term care rider on your policy, that insurance company has to provide the legal definition of a long-term care insurance, which includes long-term care coordination. So paying premiums, paying directly to a third party that you're receiving care from, for example. An accelerated benefit rider isn't going to do that. It's just effectively a lump sum cash that you can take when you need it based on your life circumstances. Both of them may have to qualify by having the condition or whatever is putting you into long-term care qualified by a physician. So that remains the same. So go ahead and you can look through a couple of these things to see if long-term care versus accelerated benefit is one more beneficial for you than the other. After the gentleman and I looked through this, he felt that this particular instance, that just having accelerated death benefit was reasonable. Now with Penn Mutual, they have the ability to accelerate up to $240,000 per year off of your death benefit. So if you remember back to long-term care over here at Guardian, add this up, multiply by 12, it's about 230. Penn Mutual can accelerate up to 240. So as long as the death benefit's high enough, we can cover that same amount of coverage. And that's the kicker, as long as the death benefit is high enough. Because they say it's either 240 or it's a percentage of your death benefit, whichever one is lower. All right, guys, so this is the end of the video. My big ask here is if you're currently working with an agent and you feel like you're not being represented well, that you're not getting what you're asking for, I don't want you to automatically assume that agent is evil. Most of the time, it just comes down to education. We at Better Wealth pride ourselves on education. It's one of the reasons we do these types of videos is so that you can become more educated about what's possible for your situation. If you'd like to have me review your policy, to have someone on our team meet with you or myself meet with you, use the link below, fill out the form. Would be glad to review your insurance policy, give you any opinions on how it's currently structured. And at the end of the day, it's your decision if you want to make any changes or if you feel like you've got a banging policy. And to be honest with you, two of these conversations we've talked about today, I said, these are amazing policies. It's through the conversation of understanding what they want, where they want to go, and how much flexibility they feel like they need in their life that we started looking at other options. So thank you for your time. Appreciate you guys. I'll see you on the other side.